All right, recording is on. This is Brian Wilson from Market Structure Edge. Today is the 15th of January. So just as fast as 2025 went through, we're already halfway through the month. I hope January trading and your January in general is getting off to a good start. With apologies, Tim had another item come up at the last moment. He was planning on joining us today. He's unable to join us, so you have the B team for better or worse. But it's great to see you guys. We have a few topics to unpack today. Just as a reminder for everyone in terms of these sessions, if you could please just keep yourself muted during the discussion itself. The chat box is up at the top. Feel free to send me any questions that you might have, and we'll get going. Thank you for that nice comment, Candace. I appreciate it. Well, once again, great to see everyone. I'll go ahead and get started with a topic that I've covered one other time, but it's good sometimes for a refresher. And part of this refresher is to just actually show you some of the names of some of these participants. And here's what I mean. So this is, for those who are not familiar with this, and this will actually be a good exercise for what's been happening in the market. I'm a former buy-side trader. This is the world that I was used to right around 2000, 1995, 2000, right in there. This is the world, and you can see this slide was from 2021, but it'll actually be an interesting comparison. You can see it's a dramatic difference. It's like waking up on a different planet. Active investors, instead of having 80% of daily volume, and what these numbers mean, let's say that you had 100,000 shares that traded of a particular company. Back in the day, active investors would have been 80,000 of those shares. So they would have been the primary reason why shares were moving higher or lower. Well, as you can see, it's been a dramatic difference now. That active number is at about 10%. It's been stable at about 10% over the last five or 6 years. So you have your stock story, and this is what you hear on CNBC all the time. You have fast trading to a certain extent. This is the market makers, those who are setting bids, setting offers, and then just trading on a daily basis. They're trying to get flat, all things being equal by the end of the day. Passive investment, you're familiar with this category. It continues to grow. Think about index funds, ETF, quant funds. Take a peek at this number, 20%. Back in 2021, it was 20%. Back in 2022, it was the same number. I'll show you what that number is here in just a second. And lastly, derivatives related strategies. I updated this slide just recently. Look at this passive investment number. So we went from 20% of daily trading back in 2021, 2022. It's all the way up to 26% now. So passive money is continuing to have a greater influence in overall trading. Active money is about the same as it was before. Risk management is increasing as well. That number went from 17 up to 20%. So we're getting some growth in these two categories. As I mentioned, active money staying about the same. When you see these categories in terms of leadership, for instance, if you're looking at a particular sector and it says passive money was the lead behavior during the last week or whatever, what does that mean? Well, we already covered it, but active money cares about your stock story. It's the CNBCs of the world. It's the fundamentals. It's the PE ratio. It's all of those things. Passive money cares about characteristics. What do I mean by characteristics? Well, think about market cap. That's the primary characteristics that's going to impact trading. Think about sector characteristics. volatility characteristics, factor characteristics. That it's those types of things. Sometimes it's inverse leverage or regular leverage, but it shares are being held because they possess a characteristic that passive investors care about. In terms of fast trading, think of high frequency trading strategies. Once again, trying to get flat by the end of the day. It doesn't always work out that way, but ideally they don't want to hold any overnight positions. Usually they don't, because a lot of times these strategies will move in and out, blink of an eye type of thing. And lastly, we have the risk management component. And once again, that's options, forwards, futures. And if you give me just a second, I'm going to need to.
No, she wanted. I didn't.
Sorry about this. We're getting some noise there. I think they might have muted themselves. And lastly, the risk management portion. And I promised you that we get a few names. Here's a few names of examples of each type of behavior, what that might look like in the marketplace. Examples of active investors, examples in the passive investment bucket. You're very familiar with index funds. Of course, you have quant fund influence. Here's some of those fast trading firms. You'll recognize the names of some of those players. And then you have hedge funds in the marketplace. They're going to take up a lot of that risk management space. Let me stop sharing here for just a second, see if any questions have come in, and see if I think we need to mute at least one person. Okay. We had one question coming in. Question from Brad. Would a swing trader like himself, would that count as fast trading, even like the edge portfolios that get in and out in a few days? Brad, you would be considered a fast trader because more than likely your order flow is being captured by some of these players. And let me share my screen again and I'll show you. So if you look at these fast trading firms, basically these guys have bought out the retail order flow. So I trade through Charles Schwab. I trade for free. There's a reason for that. That order flow has been bought out by the fast trading firms. So as a retail trader, if I set, for instance, if I set limits on my orders, they're going to have that information from me and from the millions of other participants that are out there. So that information, it gives them a certain advantage. They know where all the limits are. They know where the players are. Of course, that's limit order flow, but it gives them an inherent advantage in the marketplace. But to your question, yes, you would show up in the fast trading bucket. I think we have one other question, and just a question from Brad. Thanks for that slides. It makes it more clear than the previous explanations. Thanks, Brad. I appreciate that. Let me go ahead and move over to my next topic. And some of these topics, for you guys that are here all the time, they are review for you. Part of it's always good to review concepts because if you're anything like me, I'll forget things. So it's good to review concepts, and then we like to review concepts as well, just for our new participants. What I want to cover briefly today is broad market sentiment over 6. So our red line here with broad market sentiment, that's 6 out of 10. And the way that I like to think about red line conditions is the market is getting just a little bit stretched, a little bit overbought. Let me bring this look back perhaps on a 6-month basis, and we can see what normally plays out with red line conditions. So here in green is market structure sentiment. When it gets above the red line, The broad market, and this is SPY down below, the broad market tends to level out. You can see that occurring back in August. Gets above the red line. What occurs? Broad market returns tend to level out. So the last couple of times have been very normal in terms of that type of trading. If we back it up to a 1 year look, we'll see one of the biggest outliers we've ever had. That was right through here. So we came out of the tariff related activity that contributed to declines in the market. Everything was very oversold. Market participants came screaming in. And what that meant is we had overbought or stretched conditions for a very, very long time. Let's see, what was that? April all the way, we had stretched conditions for about a month. And as I'll show you on this spreadsheet here in just a moment, that very rarely happens. So big exception here back in April. Let me show you what it normally looks like. So what I did with this exercise, and I need to update it. There's been a couple of other cycles. It hasn't really changed. It's not going to change the numbers very much. But what I have done with this spreadsheet, it goes back to 2020. I've been measuring when we go through the red line and then when we come back out the other side. So what do I mean by that? So, when we get above the red line, when we go back below it, how many trading days is that? What was the market return during that time frame? And then, what did it do afterwards? Did the market collapse? Did it hold in there? And just from a big picture perspective, once again, from January 2020 going forward, so about 6 years of data. If we look at those red line periods, on average, the market returns 60 basis points. So the market doesn't tend to collapse. We tend to stay above the red line for about 9 trading days. So roughly about 2 weeks. We return about 60 basis points during that time. And for the 2 weeks afterwards, it's almost the exact same number. We return about 60 basis points. So that's the big picture perspective. How does that play out in trading? Well, you can kind of see it the last couple of times that it's occurred. We move above the red line, everything just kind of, the market's been moved. In this case, market's been moving higher. Those market returns kind of fizzle out. And then in a normal environment, normal bull market, I should say, the market then just continues to move higher. A couple of weeks later, it's up another 60 basis points or so. Similar trading occurring here. Market returns level off, and then the market continues to move higher. Any questions about those red line conditions? Let's see, Candace came in with a question about the Focus 5. Let's see, did I catch that? Let's see. Okay, so question from Brad about the Focus 5 portfolio. As of yesterday for NVIDIA, it showed an entry of 183.14, but it opened at 186, quickly moved up to 188. Question is, do we update our spreadsheet or should we skip this trade? Would not have been possible to enter at 183 this morning at least. Great question, Brad. And let me find what this looks like so market participants, so everyone can see what we're talking about here. So every day, and whoever's sending out the daily note will send out the model portfolios. So I sent out the note this morning. I sent out the model portfolios as well. By the way, this is open to you, not as a trial user, but if you're a regular subscriber, and if you want to get access to this, please let us know, and Tim or I can sign you up. So what you'll get an email. It'll show this morning we have 2 portfolios. The Focus 5, it shows what's being added. It shows what's being deleted. And then the contrarian fund, once again, shows what's being added, what's being deleted. To Brad's question, what does that look like? And we'll go to the focus fives to show you what that looks like. Okay, so every day you'll once again get that order coming in. Here's NVIDIA. It shows the entry price that would have been last night's close, and that's going to then be taking into account performance then today. And in terms of what Brad was asking, well, NVIDIA quickly got away from. Well, thank you. I'm not sharing my screen. Sorry about that. I appreciate the heads up. I do that sometimes. So we're here with the model portfolios, and I'll take you back one step here to show you what I was trying to point out earlier. Thanks for the heads up. So every morning email will go out. This is what it looks like. Once again, if you're a regular subscriber and you want access to this, just let myself or Tim know. Focus fives, this was what was being added and deleted. Today, currently our contrarian fund, similar principle. So if we look at the contrarian fund for NVIDIA, it quickly got away from that 183 entry price. What does that mean? Brad, similar to you, if it gets too far away, I won't chase it. It's just a general principle for me. If it's up by 1%, 1.5%, I'll usually just go ahead and buy that name. But to that point, if it does get too far away, I'm not going to chase it. Now, the opposite can happen. I think AVGO is up today, but sometimes you'll get a new name that comes in, and there's the entry price, and once again, it's got to be based on something. So we base it on last night's close. But let's say that in the morning, AVGO is trading at 335. Well, you're going to get a better entry price than what we have in the model. So it does work both ways. I'll give you an example of what I typically do with these. Maybe it's helpful for you. Around 20 to 30 minutes into the open, by that time frame, I'll try to buy usually about a half position in whatever the names are on that day. So let's say and let's say that NVIDIA doesn't run away too far from me, and I get a half position in the name. And then what I'll do then during the course of the day, I'll just pick a couple additional spots, and sometimes I'll get better prices. Sometimes I might have to pay up just a little bit. But for me, getting that half position earlier in the morning just gives me a little bit of an inherent advantage, and I can go both directions in terms of that trade. So that's just one way that I'm handling that. Brad, does that make sense in terms of that type of activity? Hopefully that makes sense. And I'm just updating. And just as a reminder, everyone, if you can keep yourself muted, that would be helpful to us during the discussion. Let's see if there's one other question I think that just came in. Okay, Brad was just confirming that was a good approach. Let's talk through a couple of things that I'm looking at in terms of like daily trading activity right now. And I'll kind of take you through part of my thought process. I'll share my screen up front. What a concept. Okay, so daily trading ideas. I'll start with this every single day. And what I do is I'll sort by probability. And then what I'll do is I'll drop that into a watch list. So here's the watch list today for momentum. And it's been a pretty good day in the marketplace. Market up 50 basis points. It's been between about 50 to 70 basis points on the S&P 500 for most of the day. There's certain names that are automatically going to get eliminated. You know, BEASTS, those are going to be above the entry price. And what I mean by that is entry low and entry high. So that gives you a range for your positions. Right away, these are going to be eliminated. I don't even have to think about them. KTOS, form, they're going to be eliminated. And what I'm looking for, I don't trade very much intraday. One is I don't have a lot of time for that. I'm working on other things. And two, it simplifies my approach a little bit. And I'll look for names most of the time towards the last 15 to 30, 15 to 30 minutes of the day. What am I looking for? Well, I'm looking for names in that entry range. Towards the end of the day, I'm going to look at APLD and MSTR and HUT and so forth. I'll look at TER. It's only up 16 basis points. So I'll look at some of those names at day's end. Ideally, what am I looking for in those trades? Well, one, of course, is for them to be between the entry low and entry high. That's a given. That's one of the first things that I'm doing. Another thing I'm going to pay attention to is the volatility. APLD is a great example. Normal intraday volatility, and what we mean by that is movement between the lows and the highs. It's 10.4%. So if you look at APLD today, well, not too bad. It's down 80 basis points. But here's a good example. BEASTS, both up about 7%. There's their normal intraday volatility. And as some of you are aware, with momentum names, they can go both directions. So there's no guarantee that these names couldn't be down 7% tomorrow. So I will pay attention for intraday volatility. I don't like sitting on names that are down 7%. If possible, just for a comfort level, I'd rather be in that 4 to 5% type of thing. You don't tend to see all the intraday volatility come out of a name, but sometimes it can happen. And while we're talking about daily trading ideas, just a reminder, we are starting to get into earnings season. So just be aware of that with your daily trading. It's one of the worst feelings in the world to think you have a good trade on, and then earnings hits and some name is down 15%. So I don't like walking into that additional risk. So I try to avoid, trading names during earnings itself. So daily trading ideas, I'll start there every day. And then if possible, I'll put broad-based trades on. Well, let me give you an example of what I did just a couple days ago. So I bought American Airlines a couple of days ago. End of the day, last 15, 20 minutes, it fell into that criteria. Yesterday, it was lower, I think by 1.5%, gained all of that back today. And I've made, 2 to 3% on that trade. So it did exactly what I hoped it would. And once again, I had placed that trade 2 days ago, just a little bit before the close. Now, in terms of broad-based trading, what do I mean by broad-based trading? You're buying SPY, you're buying some type of leveraged long trade. Something where you think the broad market's going to move a certain direction for a certain period of time. And just so you're aware, these cycles, if you've stayed with us for any period of time, that these cycles move very rapidly. Let's pull this back to a 1-year look, and I can show you what I mean. So it's very normal, demand and supply. Well, we're looking at demand here, but broad market sentiment, it just waxes and wanes over time. That's just the way that the market plays out. So you'll get these cycles, they'll last a little while, everything will pause for a period of time. And if it's a normal market, you'll get those cycles moving back into play. So the point is, for broader based moves, it's hard to go more than a week or two at a time. You just get a lot of movement in terms of overall overall sentiment. But if you are, or if you are making broad-based moves, what am I ideally looking for? I'm looking for something like this. So what am I pointing out here? Sentiment in this case was actually below 5, but you can see sentiment bottomed, started moving higher, and if possible, as that sentiment move is moving higher, I want big tech to be aligned at the same time. So what do I mean by that? If sentiment is moving higher for the S&P 500, and if big tech is moving higher at the same time, I have a pretty good chance that the market's going to move higher. There's no guarantees, other than death and taxes, but you know what I mean. You're trying to stack the odds in your favor. If we look at what big tech has been doing recently, and I covered this in today's note, well, it hasn't been going in the same direction. It's like paddling with someone, and instead of their normal stroke going backwards, they're trying to paddle forwards, and you keep hitting each other with the canoe paddle. And that's essentially what's been happening to the broad market recently. Sentiment for the S&P 500 has been okay, but sentiment for big tech had made its way below neutral, all the way down to 4.2. What does that tend to produce in the marketplace? It tends to produce choppy trading. So we had an example there of where the broad market and big tech was not pulling in the same direction. That makes it hard to go long with any confidence. One other item here, and I have a number of portfolios. I probably have too many. I probably need to whittle some of them down. But I'll show you some of the ones that I do like that are helpful. Dow Jones is a helpful one to me. Large cap is helpful. And by the way, these are pretty easy to set up, especially ones like large cap. Let me show you what that looks like. It's quite simply, what is the market cap? Market cap equals large cap. So really can't get any more simple than that. So some of those not product ones, but market cap ones, large cap, very helpful. Notice the trend here, extreme short covering for large cap stocks. Mega cap, very, very helpful. A lot of your ETF flows are going to end up moving into the mega caps. What are we getting there? Well, stable sentiment and short volume that's moving a little bit lower. Look at the short covering in mid cap. So this is what I look at every day when I'm looking at my portfolios. What are some of these main portfolios doing, or what are some of my main portfolios doing? And then you can move it down into other items. I have a couple of short portfolios. I do work on the investor relations side, so these are a couple of my clients, and I have portfolios set up for them. There's our big tech. Of course, you recognize that. Each one of you has sector portfolios. What's happening in individual sectors. So different ways that you can look at that. But what I noticed this morning when I was looking at the data, I started to notice this divergence. Really good divergence in some of these portfolios. Really good divergence in these portfolios. Is there anything that's giving me pause right now? Well, to a certain degree, what does big tech do? I know right now it's below neutral. It's starting to stabilize. Do we get like a continuation of that stabilization? I'll stop there for a second and see if we have any additional questions that came in. Let's see, a question from Brad. Circling back to the model portfolio and NVIDIA, looking at the opening trade for NVIDIA this morning where it opened up higher. And then Brad's question, is your portfolio tracking accurate for the entry and exit prices? Brad, it is tracking accurate for and it's based on closing prices. So it has to base it on something. So it's going to base it on how it closed yesterday. And let me show you that once again. Let's see, where did it go? Okay, once again, Edge Focus fives. It's going to exit Meta. It entered it at that price. It closed it at yesterday's close. There was our return that was impacting the overall portfolio. Same thing for V, and then Nvidia. It's going to enter it at yesterday's close. So it has to be based on something. And what I've seen over time with tracking these is sometimes you'll get a little bit worse entry price, perhaps, but a lot of times it'll make up for it. A lot of times when I'm exiting, we might exit a position, with yesterday's close, and a lot of times I'm getting better exit prices. So over time, I'm seeing those things even out, and hopefully that makes sense. Follow-up question from Candace. Uh, just responding to Brad. Brad, do you mean that the data isn't available until the morning and yesterday's close isn't available anymore in the morning? So that trade might not be possible in real trading. And you're exactly right, Candace. Once again, the model has to be based on something. So we base it on closing prices. Sometimes that will be to our benefit. Sometimes it'll be to our detriment. But over time, I've found that it evens out over time. And what I'm generally doing, once again, if something really gets away from me and I'm trying to enter a position, I just won't chase it. Maybe I'll get a half position done for something. And my approach, just to go over that again, I tend to get about half of my position done in the first 30 minutes, and then I can either average down for better prices, or I might have to pay up just a little bit. But it just helps me to get a start on the trade, and then I don't have to worry about it as much during the course of the day. Let me go ahead and cover what I see as we look ahead here, and then happy to pick up any additional questions that we might have missed. So just as a reminder, today was the beginning of options expirations. It can be an inflection point for the market. We've seen that very clearly during the last two expiration cycles. And let me move. I don't know why I did that. Okay. So last couple of expiration cycle on the charts, the green squares show us where options expirations occurs. Uh, Downside into November expirations, upside afterwards. Downside into December expirations, gains afterwards. Does it always play out that way? No, no, it doesn't. But the point is, you have. Let's take call contracts. Someone has a call contract on a given security. Let's say it's Nvidia, and we come up to expirations. Think of it like car insurance. So you come up to that expirations time frame, and you have a decision to make. I my girls are now in their 20s, but we had teenage drivers for a period of time, and I made this decision many times. That bill comes in. What do I want to do with my insurance? Do I want to re-up it? I could add to it as well. Or do I want to, in the case of the auto insurance, drop some coverage? So every options expiration cycle, those decisions are being made and are being magnified across, billions and billions of dollars. It's going to have an impact on individual securities. It's going to have an impact on, a lot of times, on broad market direction. I see it over and over again with sector activity, by the way. In fact, if you want to start tracking something, look at the energy sector, and over time, take a peek at the energy sector coming into expirations, take a peek at it afterwards. You'll often see inflection points there, but you'll see that in a lot of sectors. But here's the thought. Right now, we're coming up on expirations again. We've seen what's happened the last two expiration cycles. We've had a little bit of downside. We've seen a bounce afterwards, but also be cognizant of where we are in terms of sentiment. Sentiment 5.7, we're approaching that red line. Once again, think of that as stretched conditions for the broad market. We don't tend to move much higher above that red line. There's exceptions. I showed you earlier what that exception looked like, which was back in April. So there's a little bit of a tug of war right now. Possible inflection point with expirations, but we are approaching stretched conditions for the broad market. We move into the clear next Wednesday. What do I mean by that? By asking that question, I'll show you something. And this is where you can find it if you're ever interested. I'm just going to show you the planning calendar. So under resources and then expirations calendar, and you can see any month that's occurring, and you can see right now we're right here on the 15th, and expirations 15th and 16th. What is the green? That's a market holiday, MLK Day, by the way. 21st, what does that green indicate? Well, that's VIX expirations. And once a quarter, you'll have VIX expirations that is out of line with regular expirations activity. What do I mean by that? Here's the normal rhythm. Wednesday, VIX expirations, regular expirations Thursday and Friday. So it normally lines up on a Wednesday, Thursday, Friday. You can see that in March. But once a quarter, you'll see it line up in a different manner. You can see that in May. It's that one's actually different. It's the next Tuesday in May, and there's regular expiration. So the point here, we really don't hit the clear in terms of expirations until next Wednesday or Thursday. So just be aware of that. Be aware that if you're holding positions, buying something on a Friday, you're holding it until Tuesday because of the market holiday. And this is just me. I just shared with you the way that I trade. When we get to the end of expirations, I tend not to place too many trades. Why is that? And what I'm talking about is the daily trading ideas. Why do I not place too many trades? Well, this is an expiration cycle, but it concludes right there on the 16th. So I don't know for sure if the same strategies are going to carry forward to Tuesday and Wednesday. I might have a decent idea, but I don't know for sure, because when Tuesday rolls around, market participants are going to be looking forward to the February expiration cycle. So that entire focus is going to change. Point in time, 16th is over. January expirations has concluded. When we move to the 20th, that focus then is very, very different. So as we look ahead, recognize that there is a tug of war that's probably going to be occurring between a potential inflection point, that inflection point being the conclusion of expirations here in a couple of days, but that tug of war is probably going to be running over into stretched or overbought conditions in the market. I think we probably move above the red line here. Probably not tomorrow, but I could see it happening next Tuesday. And just a reminder, to be careful with any positions, especially tomorrow going into Tuesday, because we are concluding one expiration cycle and the focus is going to shift to the next expiration cycle. Question from Brad, or observation. Let's see. Saw an article recently that for the SPX, most of the movement for those in the course of the year are due to the overnight moves? Have you studied that? It is perhaps amplified due to all the 0 day and 1 day expirations derivatives. I've not studied it specifically, Brad, but that wouldn't be surprising to me. Partially for what you just mentioned, and also partially for movement from an ETF perspective. A lot of times, some of those baskets can be priced essentially overnight. So you'll get a lot of that movement from passive money, or it can occur in overnight trading. So I think you're probably correct on that. I just haven't seen the studies myself. Looks like either a question or observation from Joe, and happy to take any other last minute questions that you guys might have here. And we'll wait for Joe's question to come through. Great question, Joe. I wonder how much of that will change once the market goes to 23-hour trading. Terrific question. And when that occurs, there's things to be discussed. When do you get the closing price? What's that going to be, based on? So there are things in the market that need to be addressed if we do go to that type of trading activity. Can I help anyone else with any further questions today? If not, we'll call it good for today's discussion. I'm going to turn off the recording here.